Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I want to talk about what our expectations are for 2026. I was invited on the Money Puzzle podcast, which is the Australians podcast hosted by James Kirby. And in fact, we tend to, maybe the last 2 or 3 years, have recorded an episode at the beginning of the year to sort of talk about what our expectations are. And that episode should be published and live by the time this is live, if not be published very soon or very shortly after. So I don't really like talking about what might happen over the course of this year, mainly because no one really knows, right? I mean, it's good commentary and certainly newspapers like it because it's newsworthy and everyone sort of feels like they want the insider's tip to kind of work out what's going to happen. But I like to, as you know, I like to really focus on longer term outcomes. So, if I'm investing in property, the thing I'm really thinking about is which market over the next decade will generate the best returns, not necessarily in 2026. But that said, I guess, understanding what might happen this year is not only interesting, but useful. If you're thinking about buying property this year, if you're thinking about selling property, upgrading, or making a new investment, I guess it is worthwhile at least considering what the year might hold. So what I'd like to do today is kind of break today's episode up in 2 parts. The first part, what I'd like to do is talk about the evidence-based factors that influence short-term price movements. And I've spoken about some of these previously in previous episodes where I'm looking for, is there a strong evidence link? So I spoke about this towards the end of last year I made the observation that a lot of economists talk about population growth and the amount of houses we're building as an indicator. I think they do have an impact, but not in every location, right? Because the amount of new supply housing in outlying areas has little to do with what is happening in blue chip property. But as a macro level, 100% it's going to talk to, what prices might do on an overall basis. But I think that there's a handful of evidence-based indicators that are probably better than that to sort of suggest what be happening in the shorter term. So I'm going to talk about that to begin with. And then in the second part, I'd like to talk about, like the two-speed market that we're currently seeing. And just as a preview to that, what I'm really talking about is that the cheaper properties tend to be outperforming than the more expensive properties. And that's what I'm talking about when I talk about a two-speed market. So I want to sort of pull that apart. And it's not just about first home buyer incentives. I want to pull apart that and kind of share what I think is a really interesting insight into, anchoring what a normal interest rate looks like. But I'll get to that. Okay, so let's talk about the evidence-based indicators. The first one is loan volumes. The second one is overall sentiment. And the measure I use there is interstate migration. So that's really the number of people that are moving interstate, the number of already residents that are moving interstate. And then I'm going to talk about relative value, which is really the trend of mean reversion. I think they're the kind of 3 that I would look at in order to sort of build a bit of a picture on what's going on in the market. So let's start with loan volumes, which, loan volumes matter, of course, because it's a direct read on buyer demand across both new and established property. And, whilst we can change housing supply, although, with all the rhetoric that's been going on and the ambitious goals that the federal government has set with respect to increasing housing supply, we know that it's relatively fixed. And it certainly can't change overnight, whereas lending volumes can. And that's why lending volumes tend to translate to an increase in price, because what they're saying or showing us is if there's an increase in lending volume, it means there's increase in demand for housing. But of course, the market can't respond to that increase in demand by building more houses to satisfy it. And as a result, it translates into price increases. Also, new housing supply are in certain geographical locations. So that also has an impact as well. So when we talk about lending volumes or loan volumes, there's really 2 levers that kind of do most of the work. The first one are serviceability rules and credit policy. So that's really what appetite do the banks have to lend to individuals. So you might be aware late last year, the banking regulator, APRA, tightened high debt to income lending. So they put a cap on that for the banks. And so that puts a constraint on, how much money that they're going to lend to individuals, particularly on a sort of high debt to income basis. Now, it's important to understand that that only applies to banks, what's called ADIs or authorised deposit institutions, i.e. banks. There's a cohort that fall outside of that, which are non-bank lenders. And non-bank lenders aren't regulated by APRA, they're regulated by ASIC. And so what we're seeing is that there's certainly tighter constraints around the banks, but that hasn't impacted non-bank lenders. And as a result, there's a growing disparity between bank borrowing capacity and what non-bank lenders will lend you. And for those old enough, it's a little bit reminiscent of the early 90s when John Simons launched Aussie Home Loans to, bring better competition into the mortgage space, which it did. And that was one of the first, Adelaide Bank was probably, no, Aussie Home Loans probably one of the first non-bank lenders in Australia. And it's funny how cycles move because non-bank lenders are kind of having their day. So some examples of non-bank lenders are Pepper, Liberty, Resimac, Firstmac. Those four are pretty much the four largest players in Australia. And so when we look at borrowing capacity for a particular individual, the bank might be 800,000. The non-bank lenders might be up to 1 million or 1.1. So it's actually a material difference in borrowing capacity and can help, certainly help individuals implement their goals. Now, the second lever that has an impact on lending volumes is, of course, cost of borrowing. So interest rates, the price of money, if you like. And when interest rates are high or expected to rise, of course, demand typically slows. When interest rates are low or expected to fall, of course, that tends to lift demand for lending as well. That means that we have to then consider interest rate expectations for 2026 when thinking about lending volumes. Now, at the moment, the market's pricing in 1 to 2 hikes this calendar year, but it's going to largely depend on inflation data and particularly the more stable quarterly data. So we get December 25 quarters data next week. So depending on what that tells us, gives us an idea of what the RBA might do with interest rate expectations, interest rates, I should say, for 2026. The thing is here, I need to be really careful, clear that interest rate expectations can literally change overnight. So we can't anchor ourselves too much to these expectations or at least put too much weight on them because literally it will change. All the rhetoric today is there's going to be increases. And, if that inflation data for the December quarter surprises on the downside, all of a sudden the whole rhetoric will turn and talk about rate cuts again. So we can't get too excited about these things can change overnight. Okay, so lending volumes is one of the evidence-based factors that I look at to determine what might be happening in markets and happen in markets over the shorter term. So let's then look at what is the current trend. So what is that data telling us? And we only have data to September 25, the September 25 quarter. We get the December 25 quarter, I think, in February sometime. So there's a little bit of a lag with the data, but I don't think it's going to change that much because unsurprisingly, over the last 12 months, so 12 months to the end of September 25, it shows that both Queensland, Western Australia and South Australia really had the highest lending growth. And that growth ranged between 10 and 13% for both owner-occupiers and investors. They were all in that range. So double-digit growth for owner-occupiers and investors in all three of those states. Really strong momentum, really strong buyer demand. So that would suggest that those three states will continue to grow, and they're the ones that have been the performers in terms of growth. New South Wales lending grew around 6% for owner-occupiers and 3% for investors. So certainly lower half or less than half of the growth of those other three suburbs. And again, that's why we're seeing New South Wales growing, but not as a faster rate. And Victoria is the clear laggard. So owner-occupier lending up about 5%, so kind of in line with New South Wales, but investment lending contracted by 2%. So I guess that's not a big surprise because sentiment is very negative in Victoria with respect to investors, although it'd be interesting to see what December quarter data tells us because I've said before on this podcast, that if you speak to any buyers agents around Melbourne, a lot of their new business is coming from interstate investors. And so, I think maybe there might be a little bit of a lag in that data, but interesting to see what December and also March quarter data tells us, because remember, loan volumes are based on settlement dates, not actual purchase dates. And we might purchase on a 90-day settlement. So if we purchased in, let's say, August last year, that settlement won't happen until the December quarter. But it'll be interesting to watch And that's why I say this is one of the key bits of data, because if we do see that data tick up, that gives us an idea that we might see better growth in the Melbourne market. Now, the next evidence-based factor is sentiment. And sentiment, the best measure, I think, or indicator of sentiment is interstate migration. Now, interstate migration is a useful barometer not because of the absolute number of people. So that is 10,000 people moved to Victoria, so now we've got to find 10,000 new homes. It's not about that, because the number isn't that material, really. It's more about the trend, and it's more about the trend relative to recent trend and also relative to the long-term trend. And that tells us, whether sentiment is changing and, whether that's it's either going to be kind of a real-time indicator or potentially a leading indicator in terms of price growth. And I remember we saw this, I certainly noticed this in 2018, in calendar 2018, when interstate migration really turned around for Brisbane. And we know that growth, the Brisbane market started to grow towards the end of that calendar year. So that's a perfect example of this interstate migration thing being a pretty reliable indicator. So let's look at current trends. And before we do that, I want to talk about what is the long-term trend, because there is a pretty consistent long-term trend, particularly for the larger three capital cities. For the other capital cities, the data can be a little bit more noisy. So for context, typically New South Wales loses roughly 5,000 people per quarter. So it has a net negative outflow. Victoria loses around 1,000 people per quarter. Western Australia gains between 500 to 1,500. South Australia about 500 to 1,000 per quarter, and Queensland gains roughly 6,000 people. So just typically on a typical quarter, or an average quarter, you should say, over the long run, 5,000 people from New South Wales and 1,000 from Victoria essentially move to Queensland. That old sort of trend, everyone moves north eventually, is certainly alive and well in the data. So that's what we should expect. That's what's normal, if you like. So then now let's look at the latest data. So the latest data is that on average over the last 12 months, around 5,500 people per quarter are moving to Queensland. So that's only slightly below that longer term trend. So that might be suggesting that, Queensland's still got positive sentiment, but the sentiment isn't as positive as it's been in previous years. Western Australia, around 2,500 people per quarter. So remember, it normally ranges between 500 and 1,500. Again, that's not a surprise, because Western Australia, Perth, is certainly only a few years into its growth cycle, which I'll talk about in a second. New South Wales has been losing around 6,000 people per quarter, which is slightly above their long-term trend of 5,000. South Australia has been losing roughly 300 per quarter. Normally it loses between 500 and 1,000, so that's quite positive as well. And again, we've seen that reflected in the property price growth in Adelaide. And Victoria has been losing only about 200 people per quarter, which effectively is really flat. And remember, it normally loses 1,000. So certainly I think that's probably a bit of a normalization of what happened over COVID. A lot of people left Victoria. So I think if you were thinking about leaving Victoria in the next 5 years, back in, say, 21 and 22, you would have done that. You would have made that move at that stage. And I think that's what we're really seeing in the data. So it might suggest that Victoria's sentiment is changing, but it's a bit difficult because, the data over that COVID period is a little bit unusual. But it's certainly, Victoria is not losing as many people as it has over the long run. I guess that's relatively, or at least to some extent, positive. So, on this basis, both Western Australia look like, again, the standout states. They're gaining the most. They've got the sort of strongest sentiment. And as I said, maybe Victoria, whether it's a signal that buyer sentiment or sentiment around the state is turning positive, I'm a bit skeptical about that. But at least the positive is we're not losing a huge number of people. Now, the last one was really relative value, and I think that certainly has an impact, and the timing when it has an impact is less ascertainable, but it's certainly one of the things that will add weight. And remember, it's not just one factor, it's really a number of different factors that tend to have an influence here, and it's hard to isolate the impact of any one of these evidence-based indicators. But what I did last year in the blog this time last year was look at the growth cycles and the flat cycles in all capital city property markets since 1980. And so there's more than 45 years of data there. And in broad terms, the growth phase has lasted around 10 years. and the flat cycles, which tend to follow growth cycles, averaged around 7 years in length. But of course, both growth and flat cycles can last longer than those averages, of course. Melbourne had a pretty strong growth cycle at one point, lasted almost 20 years. A flat cycle in Perth lasted about 12 years, the most recent flat cycle. So, of course, they can move outside those trends, but it gives us a little bit of, if you're forming a view on sort of shorter term price movements, I think it helps us consider, where markets might be in the cycle. Is it the beginning of a growth cycle? Is it potentially towards the end of a growth cycle? And if it's towards the end of a growth cycle, then, each subsequent year, in terms of your expectation of returns for each subsequent year, should be maybe, cooled a little bit, on that basis of mean reversion. That is, returns that eventually revert to their long-term mean. So when we look at current trends then, Brisbane's current growth cycle began sort of late calendar 2018, as I said previously. So it's now into its 8th year in terms of growth market. So that obviously it's closer towards the end of a growth cycle than the beginning. Having said all that, I think in the lead up to the 2032 Olympics will still probably underpin sentiment for longer. And so it wouldn't surprise me if that growth cycle extended beyond 10 years. Adelaide's growth cycle also started around 2018. However, I'm a little bit more skeptical. I guess if I'm comparing Adelaide to Brisbane, I'm probably more skeptical about Adelaide extending beyond 10 years versus Brisbane. Or maybe the better way to put that statement is that I'm more optimistic about Brisbane than Adelaide. I mean, the price growth in both those markets have been pretty strong, really, since, the end of 2018. Median house prices are up more than 80% since that time. So, you've kind of missed a little bit of that upswing, if you're thinking about making a new investment. Perth is at a different stage of the cycle. Its growth cycle only sort of kicked off mid to late 2022, which suggests it's still early, and I would not be surprised. My expectation is that growth cycle will last for another 5+ years, and there's still plenty of upside in that market. Melbourne's, again, the outlier, unfortunately. In real terms, the market's been flat for a decade. The growth rate's equal to the inflation rate, so no real growth. And as I said previously, the longest flat cycle since 1980 is Perth between 2011 and 2012. Sorry, 2011 and 2022, and so, Melbourne's kind of 10 years into a flat cycle. So you would think over the next couple of years that's going to turn around. And Sydney's a bit more nuanced. Over the past 8 years, median house prices have grown at below average pace, around about 5.2%. But that's after a pretty strong burst between 2013 and 2016 of about 14%. So if we look over that whole period, so really 2013, 2025, the average growth rate is a little bit higher than average, so about 8% over that whole period. So it kind of, that sort of implies that the growth rate might still remain a little bit below average for another few years for that market to catch up. So all that evidence-based data sort of suggests that, again, most likely Brisbane, Perth, and Adelaide will be the best performing markets. Sydney's probably going to do okay. And Melbourne, it's really a question of when that turnaround will happen. And it could be investor-led, as it was back in 2022 for Perth. And so that December quarter data is going to be really interesting to see, how much December quarter and I think March 26 quarter data will be interesting to see, what sort of investor activity was there in the second half of the 25 calendar year, and whether that investor activity is going to drive that price growth. Now, what I want to talk about now is, as I said, the second part of today's episode is the kind of the tale of two markets. So recent data is kind of suggesting that cheaper properties are seeing stronger demand and faster price growth than higher price properties. So in practical terms, really, properties that are worth less than $1 million are generally growing at a faster rate, about 1% per annum faster rate than properties above $1 million, which is kind of interesting. And you can see this show up in the data in a couple of ways. So in Sydney, listings in the upper quartile, so the top 25% in terms of value, the listing numbers are down around 5% prior to the 5-year average, and clearance rates are materially weaker in the 2 million plus segment. So certainly showing that, there's fewer properties for sale, and the ones that are for sale are taking longer to sell. And similarly in Melbourne, conditions are softer at the top end of the market as well, and days on market. So again, how long it takes to sell a property that is selling for more than $1 million is certainly taking longer now. And Coality did some analysis to look at, properties that are above the first home buyer guarantee price cap and below. And again, they concluded that the price growth differential is about 1% per annum. And so I wanted to really think about, well, what's driving these differences, and why is the top end of the market so quiet? Because, you could say, well, it's first home buyer stimulus. That's okay. That's certainly stimulus. But why is that top end so quiet? Because it's more quiet than usual in terms of activities and price growth and these sorts of things. Now, before I get into that, what I wanted to do is just give you a little bit of a recap on what's happened to the cash rate, the RBA cash rate, over the last 16 years. Now, I picked the last 16 years because what I did is I looked at the last 3 years when interest rates have been a bit higher, the 3 years before that, which is really that peak COVID period when the cash rate was almost cut to zero. And then what I wanted to do is compare that to the 10 years previous to COVID, so 2010 to 2020, that sort of decade. And that encompasses that 16-year period. And really, you've probably got to be mid-40s or older, certainly closer to 50, to remember back in 2008, the cash rate was 7.25%. And so if you've had borrowings through that period and you look at the cash rate today, which is 3.7%, you go, okay, that's kind of normal. But if you are younger than, say, mid-40s, it's quite possible your entire borrowing life has been a very low interest rate environment. And that can create some psychological challenges in terms of dealing with, a slightly higher interest rate environment. So let's look at the time-weighted average RBA cash rate over those periods that I mentioned. And the time-weighted cash average rate just means that it accounts for the fact that if interest rates during a period were lower for most of that period, then it obviously pulls the average down. So between 2010 and the end of 2019, so that decade prior to COVID, the time-weighted average cash rate was 2.6%. So about a full percent lower than what it is today. Of course, we know in the first 3 years of COVID, calendar 2020, 21 and 22, the interest rates were slashed. So the time-weighted average was about 0.6%. And the last 3 years, so 23, 24, 25, the time-weighted cash rate just slightly over 4%. So as we can see, when we look at the time-weighted average between 2010 and 2022, so in the end of that sort of COVID period, it's 2.13% versus the cash rate today, which is 3.6. So the issue here is that whole generation, potentially, anyone that's probably mid-40s and younger, has just been used to a very low interest rate environment. And what happens is you get kind of psychologically anchored to that interest rate environment. You have a bias towards it. You make lifestyle decisions based on those sort of interest rate experiences. And then when interest rates, are above that, it kind of feels wrong. It feels like it's an anomaly rather than returning to something that's kind of normal. And, that's the issue, is that, we've become, the cheap interest rate has kind of become our baseline, or at least for that cohort that hasn't had that longer term experience. And as I said, that baseline gets embedded into lots of different decisions: lifestyle, financial, buying a home, upgrading, investing, these sorts of things. And when interest rates change quickly, and of course they do, behavioural change takes a little bit longer. There's always a bit of a lag to readjust what normal looks like. And during that sort of lag or refusal phase, the psychologists call it, many households just stop making financial decisions. And actually research suggests that it typically takes around 1.5 to 3 years to kind of re-anchor to a new normal of interest rates. And really, if the RBA is telling us that the neutral cash rate is somewhere between 3 and 3.5%, then really today's interest rate settings shouldn't be really regarded as high. They should really probably be regarded as normal. And in fact, the previous to the last 3 years, that previous 13-year period, that should be regarded as abnormal. So I think that's one factor that's impacting that higher end of the market is there's a lot of buyers, a larger cohort in that market that are kind of recalibrating, particularly if you've got larger debt. If you've already, if you're older, you probably don't have a home loan or not a material home loan, and so you're not as anchored to that. The other thing too is the serviceability ceiling, and that's had an impact. I mean, of course, it's all interrelated. Interest rates drive borrowing capacity, of course, and over the last sort of 3 years, serviceability, so the amount that people can borrow, has been compressed, and it's certainly compressed materially to compared to what they could borrow, say, between 2010 and the end of 2022. And because of those borrowing constraints, investors are now typically can be more focused on yield, rental yield, that is. And so because borrowing capacity is tighter, the amount of rent that I'm going to get from the investment property that I want to buy is start to become more important in terms of supporting that borrowing capacity. And as a result, more investors can be more focused on rental yield and therefore maybe be attracted to that lower end of the market or properties that are in regional locations, that are going to kind of underpin that borrowing capacity. Again, that anchoring effect, I think, is still at play because, if you're kind of used to what you can borrow over the last 13-year period and it's changed significantly over the last 3 years, it does take a little bit of time to kind of course correct our expectations. And lastly, of course, there's the government stimulus. So the home guarantee scheme that's now uncapped, that doesn't have any income caps on it. And in most markets, that's sub $1 million in terms of the price cap. In Sydney, of course, it's sub $1.5 million. So that's certainly having an impact. But also beyond government, policy, another driver is family assistance. So, the bank of mum and dad, according to some research, is now the fifth largest lender, if you like to call it that. You talk about the big four, Bank of Mum and Dad is number 5, as well as just the broad intergenerational wealth transfer that's occurring. So when that happens, we're helping younger people get into the property market, and they're typically at a price point that's sub $1 million. So I can't really point to, with a very, very high level of confidence, to why we've got a two-speed market. But I think it's a bit of interest rate anchoring. I think it's a bit of serviceability ceiling and dealing with a very material change in borrowing capacity and credit policy rules. And then, of course, the government stimulus and the greater proportion of first home buyers coming in at that level. And that could potentially pull median house prices down just because we've got a lot more data, a lot more transactions in the sub $1 million level. So that'll be interesting to see how it reflects in the data and whether that data, that median level data, truly tells us what's going on the ground. So what does this all mean for 2026? Well, I've spoken a lot in this podcast about investment grade apartments in Melbourne. It's an asset class that has delivered very little growth over the last 10 to 13 years. I think investors that own those types of properties are likely to be rewarded in 2026 and beyond just because of the price point and all the things that I've just spoken about. I suspect that premium suburbs in both Melbourne and, to a lesser extent, Sydney will probably continue to underperform unless we see a genuine upside surprise in interest rates, so that is interest rate cuts. Adelaide looks sort of closer to the end of its growth cycle, so I'd be cautious about making substantial new commitments into that market. That said, I acknowledge that certainly growth cycles can last longer than we might ever expect. So therefore, I think Brisbane and Perth remain the standout markets in 26, which is no news to anyone really, given they've been the standout markets over the last couple of years. Looking further ahead, to 27 and beyond, we might see, the anchoring of higher interest rate environment or the anchoring to a lower interest rate environment fade a little bit. And the big thing in Victoria will be the state election at the end of this year. If we see a change in government and most people then expect that to, change Victoria's prospects and financial management, that could see a resurgence in sentiment in Victoria and in particular Melbourne. So there you go. For what it's worth, they're the indicators that I look at in order to build a view on what property price growth might happen in 2026. For what it's worth, and I might just leave it there. Don't have any times for questions today, and until next week, bye for now. Before we wrap up, I've got a quick request. Apple and Spotify decide whether this show reaches you, and I never want to lose that connection. Email is the only channel I truly own. If you're comfortable, please leave me your email. I will not spam you. Each Wednesday, I'll send you one email with an update of new blogs, episodes, presentations, and videos that I've published. All content. Just visit investopoly.com.au/email to subscribe. Thanks a lot.